Welcome back to Maverick Psychology Corner, and today we're going to look at herd behavior. So, as always, put these things into your trading plan. Herd behavior is interesting because it's a risk to investors. It's probably a reward opportunity for traders. So, it's kind of, when we talk about herd behavior, this could be a very good thing for the trading community. A little bit of background here. This is a behavioral instinct where people tend to join groups and follow the actions of others. This comes from nature, really. We feel more comfortable. There's strength in numbers, right? It's lonely being a contrarian. Back in the Stone Age, I suppose, if you were solo, the risk of death and so on was a lot higher than if you had a community around you. So there's strength in numbers, and people naturally feel more comfortable in numbers. They kind of feel like, well, they're I trust the opinions of other people more than my own, and that lack of confidence can get you into trouble at some key points. What are the risks? Well, of course, herd instinct. It can scare, it can create asset price bubbles, it can, cause panic buying, panic selling, crashes, all those sorts of things, because when the herd gets moving, it gets moving. So think about Bitcoin. I love that Warren Buffett quote that basically said people become interested in something because its price goes up, not because they know anything about it. So, Bitcoin being a perfect example, the more the price has gone up, the more interest it has driven, right? So, it's not interest. I mean, are most people really interested in blockchain and understanding blockchain? And so, no, they're interested in a price that is moving. And really, what it comes back to is people don't want others to make money without them. So they become interested. It's like the FOMO trade, right? Fear of missing out. That's what creates bubbles. Think about examples of bubbles that you've experienced in your life. Think about in the late 90s. Maybe you're not as old as I am, but in the late 90s, everyone wanted to become a day trader of tech stocks. Tech IPOs were booming. And so it drove interest into the e-trades of the world, and people were trying to day trade and they're, on their half hour breaks. And I mean, it was this crazy environment. Why? Because prices were moving, it drove interest. What happened in the mid 2000s? The housing bubble boom, right? And so as housing prices boomed and people were making money, everybody you talked to was, well, I'm investing in real estate. I got interest only loans. I acquire new prop. It drives interest. Prices drive that interest. Now, the interesting thing about that is speaking to us as traders, what do you want to do with that? Well, you want to be on the side of the herd. The best money making opportunities are with the areas that are creating the most interest, right? Now, there's going to be massive, massive volatility because these will go through their own boom and bust cycles. Like, back here, Bitcoin collapsed from 17,000 to 4,000 or whatever, and then recovered. And now we're up to 60, 70,000 or whatever Bitcoin's priced at right now. There will be boom and bust cycles, but make no mistake, you want to be on the side of the bubble. So, until it bursts, of course. But as traders, we can be quick, we can be active, we can trade both sides of the market. This isn't as much a risk to us as it is to an investor. An investor says, well, I'm getting in. They won't get out. It'll be like, well, they'll anchor to their purchase price. And if the price goes down, they'll be like, well, it'll come back. And then it doesn't. And then they're still holding. And then it's worse and worse. And pretty soon the bubble is burst and they're in a world of hurt. But if price is moving with energy based on herd behavior, you want to get into that. I mean, as a trader, I would pretty much ask myself, what has the most energy? What markets have the most energy? If I'm trading in stocks, okay, what sector is moving? Which one is booming? Which one's busting? Those are the areas of focus. So it's a weird kind of thing to tell people, yeah, find herd behavior and take advantage of those price moves. That's essentially what you should do because you're quick and you're active, right? So this can be a reward possibly, but you've got to manage that risk and understand that when these things turn, they'll turn violently and so forth. So I'm sure as this video ages, Bitcoin will have gone from, it's 70,000 price right now back down to, I don't know, 25,000. It'll go up to 85. I mean, it'll have volatility, but it definitely has that herd behavior behind it. So, herd behavior occurs in finance when investors follow the crowd. It has a history of starting large and sometimes unfounded market moves. These can be all sorts of things. Think back a few years, if any of you were trading, we had some flash crashes. Now, what's a flash crash? Basically, something triggers a massive amount of selling, and pretty soon everybody's selling, but nobody knows why. There was a great example of this where somebody fat finger mistaked, they accidentally hit the wrong button and sold a bunch of S&P contracts, and the market kind of took a hit, which triggered some more selling. And pretty soon, everybody thought, well, has a bomb gone off? What terrorist activity? And so the selling kept going. And for the next 5 to 10 minutes, the market was crashing to the downside, 6, 7%. Will flash crashes happen again? Probably so, But everybody looked around and went, does anyone even know why we're selling? And everyone went, no, nobody knows, right? It's herd behavior. Those things will happen in the markets. Sometimes herd behavior becomes worse, especially on the downside, due to margin clerks. If you think about margin, as prices start to drop, brokerages will start to liquidate their clients. If the broker's at risk of losing, if this person's taking a huge hit, brokerages will they'll execute sell orders at market, and it'll further fuel that sell off. So that's one of the things that you want to look for when markets are dropping sharply. You want to think about the margin clerks, right? The margins that are being auto sold. And those will usually kind of mark the bottom. But boy, it can create massive, selling at the tail end of downward moves because the brokerage itself says, essentially, we don't really care about this client as much as we care about not losing money, right? And so what they're saying is, we're not looking at the price and going, well, is it a good asset? Is it a good price to sell? Or should we work limit? They're not thinking in those terms. The broker is thinking, we don't want to lose any money, so we'll liquidate your positions, And so that happens when you get sharper market declines. People don't like to watch others make money without them. That creates the bubbles. That creates the herding on the upside. Avoid herding by sticking to your plan, not getting sucked into the euphoria or the fear of the moment. And just, you can trade where there's energy. You can trade within a bubble that's forming and keep, making money off of it, but do it according to your plan with solid risk management techniques. Don't take crazy, unlimited risk positions. Just, hey, I'm going to keep trading this because this is the direction, this is the momentum, this is the trend, and this is the opportunity. Hope you've enjoyed this class on herding. We'll see you next time.